What is up, everybody? This is Everything Phoenix YouTube Live edition, and we are here on Monday, July 8th. Hopefully, everyone had a great 4th. We're going to dive right in here and talk about the market, the housing market, which I'm assuming that's why you're tuning in to begin with, because that's what we're about, right? The housing market, the data, knowing what's going on so you can make informed decisions heading into the future, especially in 2024, because we don't know what's going to happen here. Um, Obviously, no one does here, the back half of 2024, but it's an interesting year to say the least. Why? Because we still have very high interest rates. We still have higher than expected inflation. We still have all these things occurring, and we have a presidential election happening later this year as well. So how does that play a role in everything that we're doing? But I'm glad you're joining us here today because we're going to dive right in. And I appreciate everyone who attends and watches. And if you don't mind, just let us know where you're watching from. We would really appreciate it. It helps the algorithm with YouTube. Make sure we curate content to be as good as possible to our audience. So if you don't mind, just letting us know where you're calling from or watching from, I should say. That'd be great. And again, any questions would be awesome as well so that we can answer those and have a conversation, right? It's always better when we have a conversation if that's possible. And if you're watching a replay, thank you very much. Leave comments below. Even though you agree or disagree, we like it either way so that so everyone can understand what's going on in different point of views here. Okay, guys? So we're going to jump right in to this live edition on YouTube of Everything Phoenix. Here we go, guys. I'm going to share my screen and we're going to rock and roll. So front and center on the screen here, I love this quote, right? Now, I'm a real estate agent. I have been so with Real Broker now for several years with this company, but in general, 19 years as a real estate professional here, agent in the Phoenix area. So we love our city, love everything that has to do with it. And that's why we're doing the show, guys, to keep people informed. This quote is awesome. Most agents know what's happening. Good agents understand what's happening, but great agents can explain what's happening. So I'm going to hopefully put myself in that category. It'll be up to you to determine if that's true or not at the end of this as being a great agent, because I'm going to explain what's happening. Now, it may be a different point of view from what you have. That's okay. But I'm at least going to explain what's happening in terms of the information and data. All right. And then if you go to the next one, we're going to talk about the overall U.S. 2024 second half of the year economic forecast and what's happening. So here we go. 2024 home prices, the forecast. Now you can see at the very bottom here, you have the percent appreciation or depreciation based upon several different prognosticators in the housing market, if you will, right? Number one is Fannie Mae. Then you have HPES, MBA, Goldman Sachs, NAR, Zillow, Freddie Mac. All right, now they each have their own opinions, as do you and I, on this data and what's happening with the economic conditions. But you can see right here that the 2024 home forecast on the price appreciation is all positive for the end of the year. That's interesting. Now, we may not see a whole lot of appreciation towards the back half of this year. This is the whole year combined because we did have appreciation across the board for the most part the first half of 2024, even though we had higher interest rates. All right, so you can see the average of all 7 is 2.9% of price appreciation for the entire year combined. Now, again, this is forecast because we know what we have so far, but we don't know what the second half entails of 2024. But overall, everyone is agreeing, or not agreeing. They're all have some appreciation for this housing market in 2024 at the annual average of 2.9%. All right, let's go to the next one. Mortgage rates projections. Now, this is important, guys, because we all know the housing market is going to hinge on the mortgage rate predictions. Okay. But their predictions are projections, if you will, for Fannie Mae, MBA, which is the Mortgage Bankers Association, National Association of Realtors, NAR, and all three. So you can see in Q3, which we are in now officially with the back half of this year, starting with July, 6.8% Fannie Mae, MBA 6.7. You can read that. All three average 6.73. Now, in 2024, they're all assuming it's going to come down a little bit to 6.57. Interesting. In Q1 of 25, 6.43. In Q2 of 25, 6.30. Okay. Do you agree or do you not agree? Let us know. Put yourself out there. I'd love to see what you think. I tend to agree with this to an extent. It's going to have to come down because I think we're going to go into a little bit of a mild negative growth on the economy. And if you put two of those quarters back to back, that is the definition of a recession. Now, I don't want to say we're going to be in some mild recession. I don't know, obviously, but you do see the economy slowing down. You do see housing demand starting to slow down. Does that mean that the wheels are falling off? I don't think so. But you see these things, these trends that are happening, right? So there you go on the mortgage rate projection side of things. Let's go to the next slide. When will the Federal Reserve cut the federal funds rate, which coincides specifically with the slide we just talked about? Now you can see all these different organizations that predict these types of things with also stocks, bonds, etc. Barclays, Citigroup, Fannie Mae, Goldman Sachs. You can see the list right here. I don't have to read all of them for you, but there's a lot of them that think in September of this year there will be a rate cut. Maybe that's because it's before the presidential election. I don't know, but a lot of people are banking on that, no pun intended. And you have JP Morgan, it says November. Then you have Deutsche Bank, and you have RBC, Royal Bank of Canada, etc., saying December. And then you have some organizations saying not till 2025. Interesting. What's your take? I'd love to hear what you think about this. I can tell you one thing. We all hope it's going to be September. We all hope that the majority of people or organizations here that are predicting the federal funds dropping the rates are going to occur in September. And they're right. We all hope that. I don't know if it's going to be true or not, but we all hope that will be the case. Let's all pray for that. Okay, because that will help the housing market. Definitely, no question about it. Make housing more affordable. And then the last slide here from the adjunct professor of economics at City University of New York says, when it comes to the real estate forecast for the next 5 years, I'm cautiously optimistic. I believe we're going to see a lot of ebb and flow over the next 5 years. Some highs, some lows, but overall a healthy market. Prices should continue to rise, though more slowly, and buyers might enjoy more options as inventory expands. But remember, real estate is profoundly local. What happens on a national scale can manifest directly or differently, I should say, in your own backyard, which means because it's local, check to that local professional, guys. And that's what we are all about here on Everything Phoenix. Matter of fact, if we go local, nothing screams more local than the Cromford Report. So here we go. Look at the screen, guys. July 1st, the number of single-family detached homes available for sale right here in active ARM list listings has increased by 57% in Greater Phoenix since this time last year. 57% increase of active listings, guys. That is a lot. The additional supply in the face of chronically depressed demand has given rise to a weaker market, which is currently very close to balance. Despite this, some segments are still sellers' markets, while others strongly favor buyers because it is profoundly local. There are some price ranges here which have seen larger increases in supply. These are below 300K, up by 94%. Below 300K, up 94%. Interesting, okay? So as an investor, maybe there's some more opportunity there, okay? All right, you can see the different ranges here, guys. I won't go into all of them, but needless to say that below 300K is the highest price point where the most new inventory is on the market. And you go down to 700 to 800K, it's only up by 31%, which is still a good amount, but only 31%. And then you go 2 million to 3 million, up 28%, and 7.5 million to 10 million, up by 35%. I think that these last two are a little more seasonal to an extent. And they're not going to put them on the market because they know a lot of the buying demand, above 2 million, let's say, is more seasonal, and not a lot of that occurs, although some does during the summertime. But you have these other big numbers, guys, from 300 to 600K that are 94, 64, 76, 77%. So what does that mean? That means that inventory is increasing, and it's not just in the higher price point activity. See, a lot of people think that when the market slows down, it's only because it's the higher price points putting pressure down because no one can afford those houses. Now, there is some truth to that, of course, but right now you can see specifically, again, because our real estate market is profoundly local, you can see in the price points that are more affordable, 300K or below, up to about 600K, big numbers, guys, of increased supply. Now, I don't think supply is coming on the market at a much more rapid pace. You just have this chronically depressed, if you will, demand that is there right now. And my goodness, we need some more demand. And what would help demand the most? Interest rates coming down because people buy a monthly payment. They don't buy the list price. Okay, so let's go back to my screen here and let's talk about more with the conf report. Here we go. Listing success rate by calendar month. Here we go. You can see listing success, guys. Right now, it is at 69%. What does this mean? What this means is that for all properties that come onto the market, 69% are currently selling. 69%. The other 31% are not. They are going off the market as canceled. They are expiring. They're not selling. You can see this is equal to, right there on the screen, September of 22. And you can see in 22, the market continued to get a little bit more rough for sellers, down to 61%, bottoming out at the end of the year in December. Now, could this trend happen again in 2022? There will be a trend of probably it getting lower and lower, because that happens almost every year. Look at this graph. It goes up, down, up, down. Well, that down is usually the back half of a year, no matter what the year is, right? You can see in 23, it was December at 71%. Well, we're already down to 69%, and we're only in July. So this could bottom out, be very similar to 2022, and bottom out around 61%, meaning that a big, significant, 40% approximately of all properties will not sell that go on the market later on this year. So does that mean you just hold off until next year? I don't think so, because what if it's true in the fact that the market doesn't increase or get better, guys, just because we've had good markets in the past in the first half of each year doesn't mean we're going to repeat that. Now, normally, because Phoenix is very seasonal to an extent, it is a good possibility that happens. So that is the holdout. That's the hope, I guess, if you will. Now let's move on and let's pull up list price versus sales price per square foot. You can see right here, guys, that this is very similar to what we're talking about, right? Currently, the sales price per square foot is at $294 compared to the list price, which is at $300 on the price per square foot basis. Now, if you look at this graph right here, it's interesting because it's at percentage basis, 97.9%. Okay, that means at 97.9%, that's still pretty good overall. And that's not 100%, but it hasn't been 100% for a little bit of time so far. And what this means is that if you're going to sell or put any house on the market for a certain price, you can expect it to sell on average at 97.9% of that price you are asking. So again, there are markets around the country right now that are well below 97.9%. If you round up, right, easily, you're at 98%. If you put your house on the market for $1 million, you can expect it to be around that $970,000, or I should say $980,000 price point, because 97.9 is closer to 98% from that regard. All right. What's up, Jason? Hey, buddy. Thanks. I appreciate you, man. Appreciate you logging in and checking out what I got to say. I'm not trying to ramble here. I'm trying to just drop some microphones, right, with some good data. Okay. Thanks. I appreciate LaFlesh. Always checking in, my man. All right, guys. Anyone else wants to check in? I'd appreciate it. Let us know you're watching. I can see a lot of people are actually tuning in right now, but I don't know who you are. If you want to put yourself out there, I appreciate you. I'd love to know who's watching, whether I know you or not. Anyways, let's keep rocking and rolling with some good data. All right. So that's the list to sell price ratio. And now we have listings under contract. All right. We have 2024. You can see in the purple, which is trending just below 2023. And 2023 trended below 2022, and 22 below 21. You get the point. So listings under contract are getting lower and lower. Now, this time last year, we were at 74.30, and right now we're at 69.95 by comparison. That's an additional about 500, roughly 450 properties that are not selling that did sell last year at the same time. And the temperature was pretty much the same this time of the year in July, meaning it was still hot. It's above, 110, let's call it, regardless in July of the year. So you can't use the heat as the excuse. There is a little bit less demand. Unfortunately, that's just what it is. But will this trend continue? My guess is it probably will. Now, what gives people a little bit of hope, which is interesting, guys, is this little area right here, week 34. And then, of course, you usually have a spike around week 42. And then you have a spike around week 47. And then you end up hitting the holidays, and away we go. All right, let's go to the next graph. Listings canceled per week. This coincides perfectly with the graph of the listing success rate, currently at 69%. Well, if you got listings canceled, you can see these are trending around the same time as last year, but a little worse. Last year at this time, we were at 348. We're at 368 right now. We're 20 ahead of last year. And that's not a good thing, because that means more and more properties are not selling. So listings canceled is a big portion, a big part of the housing market. People put their house on the market, it does not sell, they lose confidence. Maybe it goes down to a price they don't want to drop to, so they just take it off the market. There no longer is that inventory on the market. Now, we do have a good amount of inventory on the market. It is increasing. And so there are more options now for buyers to choose from than ever before. And again, so you want to zig when other people are zagging. The average person, guys, will sit here, the average buyer especially, will sit here and go, you know what? Because that trend's going to kind of go down, I'm going to try to time this thing at the bottom. Well, if you are going to do that, you better be prepared to buy a house around Christmas, because that proves to be the bottom every single year on the seasonality of the market. Does that mean you're going to get the deal of the decade or year? Maybe, but probably not. When it comes to the pricing, will prices go down and you can then ride that coattail down to the end of the year? Possibly. And therefore, if you want to time it, there you go. Not a bad strategy whatsoever, because the data does prove that's probably going to be the case. But again, everything is local. We're trying to be as local as possible, but we're local to Phoenix right now, which is a big sample size. If you have any questions about getting even more local to your zip code or your neighborhood, reach out to me at 480-660-5974. We can have a conversation about your specific situation when it comes to that. Again, 480-660-5974. Or just hit us up on social media. We'd be happy to respond and have a talk with you regarding that. We're going to share my screen here and go back to the same the data that tells us exactly what's going on here with the listing inventory in Phoenix today. Are we in a balanced market? That's a tough one, guys, because the monthly median sales price now shows, this is going to be a good one here, guys, shows that overall, with all these cities, you can see right here on my screen, all these checked, okay, all of them checked, which, I mean, price points vary greatly from $100,000-ish, right, for, like a fabricated, prefab home, all the way up to multi-million-dollar mansions in all of these cities combined in the Phoenix greater area. You can see the median sales price on a monthly basis. So it's very trending every month, right? Updated daily is going up to 460, which is interesting. From last month, June 24, at 450,993 up to 460 in July. Interesting. Now, here's what's interesting. If you take that same graph, monthly median sales price, which is not the average, median, and you take the wealthier, higher priced suburbs, okay? So what I have checked here is Carefree, Cave Creek, Fountain Hills, all right? We have Paradise Valley, Scottsdale. Now, are there luxury homes in other suburbs? Of course there are, but this is just giving you a quick hit on this to know what's going on. But on the luxury side, the median sales price is actually going down from reaching a peak in April of this year, down from $881 to $829. Will that trend continue? We'll see. Again, typically it's seasonal, because the more higher price point luxury home sellers want to wait until, at least October or so before some of the buying activity starts to begin again. Not everyone does. There's plenty of luxury homes on the market right now, but some are going to wait. Okay, now take that same graph and let's go to this one right here. This one is the same thing, monthly median sales price, but for lower price homes, I took some suburbs that traditionally have some more affordable housing, like Avondale, okay? Then we have Glendale. We have Peoria. We have Queen Creek. We have Surprise. And again, I know there are more that have lower price point homes, but these are all attached to the nucleus of the Phoenix area. This is not Coolidge or a suburb that's included here overall, but not attached to the nucleus of the Phoenix area. And look what's happening, guys. Price is still, median price going down month over month. In June, it went up to 448. In July, it's now at 448 as well, but down just a little bit. You can see that movement right there, just a little bit, okay? So that means the lower price points of homes are actually staying somewhat steady compared to the higher end, since April is actually decreasing on the median basis. So we're not talking average. We're talking that takes the median sample size, which we know what median is. We're talking everything that sells. The lowest price point home to the highest price point home. What's the one right in the middle? That's the median, okay? Not the average, where the higher end prices can skew the numbers a little bit. That's why I love the median, okay? So what does this mean, guys? This means that prices are somewhat still holding steady. If you take the whole area of 5 million people in Phoenix again, and this whole armless area, Greater Phoenix, prices actually went up. Now, will that continue? Probably not, because as demand continues to stay somewhat weak, which we think it probably will, for at least the next couple of months until potentially September, when all these banking organizations think that the federal funds will drop rates in September. We'll see. No one knows. But if that's true, then that median price point potentially might go back up again. But I think until between now and September, my guess is that the median price point will continue to slide a little bit and come down from that $460,000 price point overall in Phoenix. But we'll see. Okay. But I think either way, because demand will be weaker towards the end of the year, if you have a buying opportunity and you have the ability to time it whenever you want, I would strongly consider buying in December, because the data proves that's when everyone else is zagging. So therefore, you should zig. That's right. Okay. Zig, baby. All right, here we go. We're going to wrap this up here pretty soon, but I want to share a couple more articles with you regarding mortgage rates. When will the Fed and cut FUD. All right, Fed cut interest rates. Experts say later this year, if at all. Here's why. So if you come down here, this is from bankrate.com, and you can see that the reason why, again, is inflation. This is the problem. So guys, if you read these key takeaways, this is interesting, right? Because the reason we have, the inflation reports are coming back higher than expected. It isn't coming down. It's not cutting as fast as they want to see. That's interesting. How about the unemployment rate? Staying higher than expected. Jobs are being created, apparently. But yet, if jobs are being created, rates are staying high, people aren't buying, demand is low in terms of the housing market, and therefore they aren't borrowing capital as much. And I have articles on here where showing that the commercial real estate segment right here, I can show you guys right here. Okay. Show you that the commercial real estate activity, is actually, in terms of borrowing capital, is actually decreasing across the board. And this is the article right here, guys. Sorry. Let's talk about this real quick. Then what is happening? How could this all be true? And I think that the simple answer is you got to read between the lines here a little bit. I think some of these reports are being tweaked a little bit, because you can't have unemployment rate continue to be on fire and high inflation. You can't have both those two things. Absolutely, you can, no doubt about it. But then you got to have, at some point, demand start to fall off. Okay, or otherwise it just would crank, because if everyone's gainfully employed and inflation is not terribly high, then people are going to buy. Right now, demand is not there. People aren't buy. People are struggling at the grocery market. They're struggling on the real estate market. They're struggling all these things. So what is going on? Well, this article talks about these key takeaways. I'll go back to this real quick, guys. That something has to give at some point, and that the timeline here now, or that most people, according to Bankrate, is that July's off the table. It might be September, but it very well may be only one cut the rest of this year. So will it be in September ahead of the election, or will it be in November after the election is over? No one knows, obviously, but this is the things that the markets are trying to figure out, where and what is going to happen. And if you knew these answers, you'd be in great shape, but no one really does, right? And then you go to Yahoo Finance, there's talking about the U.S. housing slump deep in this spring. Where does that leave home shoppers and sellers? Well, they're talking about more of the same thing. They're talking about that the housing market shows few signs of busting out of its 3-year funk after a disappointing spring season amid a gloomy outlook for the summer and fall. It's not a whole lot of optimism that home shoppers came into in 2024 thinking that rates are going to decline. Rates haven't declined, and therefore it's becoming more of the same, which is a little bit of a blah or gloomy outlook by most home buyers, and therefore that's why you have weaker demand. So how do we turn this around? Well, we turn this around by lowering rates. So will that happen? I don't know. But right now the Fed's in a pickle, guys, because they can't lower the rates because inflation is still not coming down. And as long as we keep printing money to spend on government projects or for other nations across the globe, it's going to be very hard for the Fed to bring those rates down, because our inflation will continue to persist. Therein lies the rub. Okay. And I know we talked about this a lot on the show, but I'll continue to talk about it as long as it's what's happening in the marketplace, because I want to bring you exactly what's the data and the facts of the matter. So let's go back to my screen here. I got a couple more articles and we'll be done here, guys. Today we'll wrap this up, but let's go to commercial real estate market. We just talked about the mixed cost of capital, where right now they're coming out thinking that it's going to be very hard for people to borrow with the commercial borrowing because of the fact that rates are still very high. Duh, they're in the same boat that residential is in. So let's go to the next article. Let's transition here a little bit, okay? Despite new apartments opening, cost of capital, they've already borrowed that money. Now they're starting to open these big multifamily projects. More Phoenix renters are staying put and renewing their leases. So what is happening with the rental rates? This is interesting, all right? Let's talk about this report, okay? The Phoenix Metro saw its apartment unit supply grow, not go down, grow by 1.18% at the start of the rental season, according to rentcafe.com. Rents have increased 48% between the first quarter of 19 and the first quarter of 24, according to Spare Room, a roommate matching site. In June, Phoenix rents increased only 0.1%. compared to 0.4% nationwide. Year-over-year rents in Phoenix were down 3.5% in June. That's coming down with probably the median sales price. Eventually, we already seen the median sales price come down in the higher end markets overall. Today, the median rent in Phoenix is $1,172 for a one-bedroom unit, and it's $1,397 for a two-bedroom unit monthly here in Phoenix, okay? Rents are showing signs of leveling off. Demand remains strong. We could see a slight uptick in the second half of this year, but I don't think demand's going to remain terribly strong. I think it's going to be fairly flat and fairly boring, if you will, right? Then you talk about all these other deals that occurred, but that's what's happening right now with rental rates in Phoenix. That is boots on the ground, real data, okay? Now, let's go over here. Arizona minimum wage increase faces pushback as it heads for ballots, guys. So if you are living in Arizona or are going to move to Arizona, this is on the ballot now, and we'll see what happens. Now, there's a lot of, this is a hot topic. People get upset at each other or one another over this topic alone because there's two separate sides of this argument. Here we go. Raise the Wage AZ is a political group behind the ballot measure called the One Fair Wage Act, turned in on July 3rd with the required number of senators to be on the ballot in November. Currently, Arizona's minimum wage is at $14.35 an hour. It has risen 8 years in a row because of the current minimum wage law requires minimum wage to increase with the Consumer Price Index. That's current law. Current law allows employers to pay tipped workers $3 less than minimum wage because, obviously, the tips, all right? The new measure, if approved by voters, would bump the minimum wage to $18 an hour with steeper increases than currently on the books. And then, of course, they're saying this is a good thing, right? This group, because that they want people to be able to earn, quote, a full and fair minimum wage to support themselves and their families. Okay. Now, the opposite side of this is Arizona families and small businesses are already struggling with rising costs. Okay, that's what they're saying. Now, here's the divisiveness, right? Because there's another section of this on the other side. The argument is that let's see here, guys. Here we go. Right now, Arizona families and small businesses are already struggling with rising costs. Now, a group of out-of-state, out-of-touch activists is what they're saying, it right, which is the One Fair Wage Act, have concocted a scheme that promises to give rocket fuel to inflation in our state, driving costs even higher and many employers straight out of business. Okay, and then he's the CEO of the Arizona Restaurant Association. The Massachusetts-based group, which is the One Fair Wage group, seeks to eliminate Arizona's successful tip credit and replace it with a California-style wage system. The ploys resulted in reduced wages for tip workers, lost jobs, and shuttered businesses virtually everywhere it has been tried. And then, of course, there's divisiveness around all this, right? And they come up with these cool names and everything, right, for whatever side you're going to be on. But it would allow the ARAs measured on the ballot would allow restaurant workers to pay tip workers 25% less than minimum wage as long as employees made at least $2 per hour more than the minimum wage with tips included. It received both support in the legislature from all Republicans and some Democrats, okay? And then while both measures would lead to increased pay for tip workers, the ARA's proposition isn't as big of an increase and would still let employers keep a bit more money on their end, which restaurant owners have claimed is in need to keep up with slim profit margins in the restaurant space, all right? So what do you think about this, guys? There's no doubt that obviously if minimum wage increases, you're going to have more inflation because those costs will be passed on to the consumer from these business owners. And then the next article here from the Phoenix Business Journal that was just written up here a couple days ago, why more layoffs could be coming in the second half of 2024. This is interesting. This is for obviously not just Arizona, but across the nation. But it said that according to surveys, 60% of businesses have cited many factors, including employee performance issues, AI taking over employee workloads, company restructuring, declining market conditions, et cetera, blah, blah, blah. But it does say that if you are an employee that has information or experience with AI, you are definitely more likely to obviously keep a position and or get a promotion. I believe this trend reflects a growing demand for AI skills in today's job market, and so on and so forth. So this is interesting, right? Because they're talking about the economy not being as great heading into the second half of 2024, with most business owners stating that there are issues they are having with trying to cut costs due to those conditions. Now, where do rates remain today? They remain at 7.01% on the 30-year fixed, and the 15-year fixed at 6.41%. And again, you can see this graph up here just stays between 6.9 to 7.4, and it has done for quite some time, going on about 2 years. All right. Now, for some good news. Okay, good news. Mesa, Gilbert, and 4 other Valley cities among national leaders in economic growth. This is cool. Okay, so right now we have what are those cities? Right now you have Phoenix and Mesa, number 1, number 3 among top large cities for economic growth. That's good. Our economy is growing locally here, right? And then you have Chandler and Gilbert, place number 1 and 3 respectively for medium-sized cities, and Surprise ranked number 5 for a small city nationwide. Peoria was up in the top, right outside the top 10, and that is a good thing at number 11. Okay, so you have a lot of economic growth happening in Phoenix. So as this article said, that some businesses are feeling the pinch to cut costs nationally, locally here, Phoenix, Mesa, Chandler, Gilbert, Peoria are doing really well, according to this report, when it comes to economic growth and businesses wanting to come to our cities to start businesses and create jobs, as opposed to have to cut jobs. So this is really good, guys, for our local economy. And I think you're going to start seeing more and more of this, which is going to obviously help demand in the mid to long term for the housing market, despite what rates do to an extent, obviously, right? Okay. Then this is also good news, guys. Construction cost increases in Phoenix come in below the national average, and the national average is 1.12%, and Phoenix came in at a 0.94% spike in cost for construction. And it's not just the large deals like Intel and TSMC. These are for just small construction projects as well across the Phoenix area. And a lot of it has to do with the industrial space as well, because Phoenix is the largest in terms of growth for industrial warehouse space in America right now, which is great. And to end, as we always do, on a somewhat fun, positive local note, everyone loves coffee for the most part. So Flagstaff, actually, their Fire Creek, coffee company opens a roasting facility in Phoenix. So they're bringing it down here, and there's a picture of their facility, which is going to be down the uptown area in downtown uptown area of Phoenix, down off McDowell Road. They are opening a new roastery, which is going to be cool, that they're going to use to continue to actually help bolster a lot of coffee production and coffee just served to consumers through other companies, big companies too, like I think Whole Foods and AJ's, right? As well. They provide their coffee for them on some of the roasteries. So cool that you see a lot of local businesses like Flagstaff in Arizona, a smaller town, about 75,000 people, now having an impact in the valley when it comes to coffee, of all things. So guys, there is a lot of pros where you have cons. You always have silver linings and good news too, but we're not going to always sit here and give you just the rosy, everything's fine. We're gonna give you the data and let you make the decision on what you need to do for your financial future, your family's future, when it comes to housing as well, and everything in between. So thank you for joining us in this summer hot edition. It's about 1:10 outside right now in Phoenix here, of Everything Phoenix. And I appreciate, guys, all the support. Let us know what you think of our channel. Comment below, and we will be sure to reply those comments, whether you agree with us or you really disagree with us. Thank you so much. Until next time, Phoenix, keep it classy.